Hi everyone, welcome back to the USCPA classes. In this particular class of financial accounting and reporting, I'll be covering part 6 of ASC 842, that is lease accounting. In this video, we'll be discussing in detail about variable lease payment, lesser consideration and the residual value. So let's dive into to understand more in detail.
Now we are starting variable lease payment. Variable lease payment, like we discussed or touch base earlier also, which is not fixed, but it depends either maybe on use basis or on a time basis or maybe input basis or maybe output basis, right? So it can be vary from period over period or month over month or time over time, right? That is called variable lease payment. So example, it may be like price change due to change in external market rate, or maybe the value of an index like commodity price index, natural gas price index, or petroleum price index, or maybe consumer price index, or maybe benchmarking interest rate. For example, you have taken a machinery for extraction of the oil on lease, right? And the price is being fixed based on the natural gas price index for the lease rental. So as the gas price will go up, the price of the lease will increase. As the gas price will go down, price of the lease may go down. So that may also be possible. So in that case of scenario, it will be considered as a variable lease payment. Make sense? Any doubt?
No, sir, clear.
Right?
No, sir.
So another example which we have discussed is like usage of car. So that like example we have already discussed many a time. If you see here in example of variable payment, that would be included in the calculation of lease liability and right to use asset, as they are unavoidable at the inception of the lease. So lease payment as a percentage of revenue, right? For example, let's assume McDonald, right? You have taken the machineries or equipments from the McDonald on a lease, right? And the lease rental is inbuilt into the royalty. So that is based on the number of unit you sell, right? So that is based on the revenue you generate. So there it is a variable lease. Next is like increase in the usage of asset, the car example which you have discussed. Keep in mind the real estate tax and building insurance are not included in the calculation of lease liability because those are actual expenses, right? These costs will directly go to the income statement as and when it arises. It is not a capital expenditure, it is a revenue expenditure. Make sense? If increase in lease payment is fixed in nature, then we should consider the calculation of lease assets or liability. If not, then we should expense of as and when they are incurred. Another topic we need to understand is the residual value. So residual value is basically an estimated value of the underlying asset which you are expecting to be received at the end of the lease term, right? It can be guaranteed residual value from the leasee side. So leasee might have guarantee you this much amount they will pay to purchase the asset, right? Or it may be unguaranteed, which is not guaranteed by the leasee, but you are expecting that market price of the asset would be like this, right? So that is guaranteed residual value and unguaranteed residual value. Residual value can affect the lease payment amount, classification, and the amount recorded by the lessor or lessee because it comes in the calculation of lease liability and right to use asset, both the side, right? So leasee side, what all consideration leasee should give for the residual value, how they calculate the residual value for the calculation of lease liability or right to use asset. First is if expected residual value, if expected residual value is greater than the guaranteed residual value. For example, you have taken a car on lease which has market value of $10,000 now, or sorry, $50,000 now, and you have taken that on a lease for a period of 5 years. After 5 years, you are expecting the market value of the car is $10,000, right? That is your expected residual value, right? And which you have now, you have guaranteed to make the payment of $5,000. You have guaranteed to make the $5,000 payment to the lessor to purchase that car after the lease term. So in that case of scenario, expected residual value is considered in the calculation of lease liability, right? If expected residual value, which is $10,000, is less than the guaranteed residual value. For example, if you have guaranteed $15,000 to purchase, in that case of scenario, as you have committed more than the future expected residual value, that means you have to make the payment, right? Then you need to use the guaranteed residual value for the calculation of lease liability, right?
सर लीजी जो है वो एग्री क्यों करेगा कि भाई गारंटेड रेसिडुअल वैल्यू एक्सपेक्टेड वैल्यू से ज़्यादा होगी, वो एसेट लेगा ही क्यों?
And that's a very good question. It depends on business case to case. For example, like you have implemented an oil extraction plant in the seabed, right? And you have taken that machinery on a lease, right? And you have already started extraction of the lease, right? And now, if you want to replace it, then probably it may be more costly affair for you, right? Or second thing, for example, if you have, let's assume you have taken, you can say the franchisee. Franchisee might be a different model, but for example, let's assume you have taken a place on rent, right? And which is in market, key location in the market, and that shop is running like anything, right? So maybe at this point of time, you have estimated like the residual value was less than the guaranteed value, but you are expected, but because landlord wants you to pay more, because now it's your place is a key place. Let's assume like Chandni Chowk, Lajpat Nagar, or Sarojini Nagar, such kind of market, right? In that case of scenario, considering the business situation which you have already set up at such place, now you might have to pay extra money, right? It's business to business scenario also.
Okay.
Unguaranteed
I got it.
residual, yes, unguaranteed residual value can be ignored by the lessee because that is not guaranteed by the lessee, whereas lessor will be considering it. From the lessee side, unguaranteed residual value is not relevant information. Make sense? Everyone comfortable?
Yes, sir.
So now look at lessor side. So lessor side, what is the consideration for the residual value? First one, when you are considering it, sales type lease, right? So guaranteed residual value is included in the sales revenue, or any unguaranteed residual value is excluded from sales and COGS, right? Only the guaranteed value is being included in the sales revenue, and you can recognize the profit because it is being assured. Fair value of the assets exclude the guaranteed residual value when you are creating the asset, right to use asset. And the lease receivable include the guaranteed residual value because it is being assured by the lessee, right? So in the lease receivable, you will be adding it. And unguaranteed residual value include in the net investment, but not in the lease receivable, right? For both sales type lease and the direct finance lease. So these are the difference between you can say lessor type of accounting and lessee type of accounting. But the key difference is the unguaranteed residual value, which in case of in case of lessor, you'll be adding into the net investment, whereas in case of lessee, you'll be completely ignoring it because that's not you have committed anything, right? And how to calculate net investment in case of lessor is the present value of all future payments, which we have discussed in above also, plus unguaranteed residual value, plus interest income, minus any payment already received by the lessor, right? That is a net investment. If you remember, in the morning, we have also discussed this calculation here in this table. Net investment, lease receivable plus present value of unguaranteed residual value minus if there is any deferred selling or initial direct cost, IDC, Right? Everyone on same page? Yes, no?
Yes, sir.
Yes, sir.
Okay. Sorry. Now, discount rate, another thing. So discount rate is to calculate the present value of the lease liability and right to use asset. Both the side. At both the time, we would be needing the discount rate. Discount rate is either implicit in the lease agreement. That means it is clearly mentioned in the lease agreement that that much amount of interest rate or discount rate to be considered, right? Or it is implicit discount rate. Implicit discount rate is generally incremental borrowing rate. What is incremental borrowing rate? For example, I am a leasee and you are a lessor, right? So let's assume I need a machinery. Let's assume I need a JCB machine for my construction business, right? So for example, if I purchase the JCB machine and I take loan from the bank, then what is the interest rate at which bank will be providing me this incremental money to purchase the JCB machine? So that is the rate is considered as incremental borrowing rate for the calculation of discount rate, right? If otherwise I would have been purchasing that asset, how much interest rate bank will be charging me for the purchase of that additional asset? That is called incremental borrowing rate. Make sense? Yes, no?
एक बार ही रिपीट कर दो, मैं मिस कर गया.
Incremental borrowing rate is, for example, I am a leasee and you are a lessor, right? Let's assume I have a construction business and I need a JCB machine, right? And you have a JCB machine. If I would have to purchase the JCB machine and take the loan from bank, what is the interest rate bank would have been charged from me to provide this loan? That is called incremental borrowing rate. Make sense? For example, JCB machine is of $100,000, right? If I take that 100,000 loan from the bank to purchase that JCB machine, at what rate of interest bank would have been provided me that loan? It's called incremental borrowing rate.
But that in that case, shouldn't be a case of sale purchase instead of a lease arrangement, because we are purchasing, we are lending,
No. We are not
asking for the money
purchasing.
to
No.
purchase.
We are not purchasing. I'm just saying what interest rate you need to consider for discounting. For example, I am a leasee and you are a leaser, right? You have a JCB machine of $100,000 and I want to use that JCB machine for next 5 years and I'm ready to pay, let's assume $2,000 a monthly rent to you, right? And I have taken that JCB machine on lease from you at $2,000 a month for a period of 60 months, right? Let's take this as an example. So in this case of scenario, to calculate the lease liability and right to use asset, we need a discount rate. Yes or no?
Yes.
Yes. So what discount rate we should consider? So discount rate either should be clearly mentioned in the lease agreement. If it is not clearly mentioned in the lease agreement, then you'll be checking my incremental borrowing rate. If I would have been taking $100,000 borrowing from the bank, what interest rate bank would have been charged to? So that interest rate you should consider for discounting.
Okay.
Make sense, Rahul?
Yeah, got it.
Ashish? Palak?
Yes, sir.
Yes, sir.
Right. Next topic is initial direct cost, IDC. I don't know why it is mentioned indirect. Initial direct cost. So direct cost is for making that arrangement, whatever the cost directly related to that lease agreement. That can be legal fees, commission, evaluating the prospective leasee, financial condition, or processing the lease document. Any such expense, right? That comes under the initial direct cost. So these costs are incurred by the lessor additionally for lease, and it is same for both lessor and lessee for the respective calculation of lease liability, right? And how do you do the accounting of it? Include initial direct cost in its initial measurement of right to use asset, and initial direct cost is deferred and amortized. Like right to use assets, you generally amortize over the period of lease term. Same way, this initial direct cost also being added in the right to use asset, and hence it is amortized over the period of lease life. Make sense? Are you guys with me?
Yes, sir.
Yes, sir.
So now let's look at accounting. From the leasing side, we have discussed lessor side, how you do the accounting. First, in case of sales type lease, if lessor is recognizing selling profit at the inception, then lessor should expense such cost at the inception. So if it is a sales type lease, then all initial direct cost would be the expense. Matching concept, because one side you are recognizing the revenue, the another side you should recognize the expense. For a matching concept, you will be booking it as an expense. Make sense? Make
Yes, sir.
sense, right?
Yep.
If there is no selling profit, the lessor should include the cost in determining the lease receivable and amortize over the lease term. If there is no profit, if there is a profit, then you need to expense off. Second category from the lessor standpoint of view is direct finance lease. So direct, in case of direct finance lease, include the initial direct cost. Include the initial direct cost into the cost of net investment and amortize the expense over the lease period, because here profit also you'll be recognizing over the period of time. Hence, for the matching concept, this initial direct cost also you need to amortize over the period of lease term. Last one is operating lease. In case of operating lease, you'll defer the cost and amortize over the lease term. Very simple, right? Any doubt how to do the accounting of initial direct cost? So far, so good. Let's do an example.
सर एक क्वेश्चन है
Hmm.
कि जो इनिशियल डायरेक्ट कॉस्ट है उसका अकाउंटिंग ऑन द बेसिस हु पेज दैट कॉस्ट इज दैट
No, whosoever will pay cost. Whether
Okay.
leasee pay cost or lessor pay cost, because it is on account of this lease arrangement only.
Okay.
Very good question, Rahul. Okay, so let's do a practice question. Under FASB topic ASC 842 lease guidance, which of the following is a correct regarding initial direct cost? Leases and lessors will apply different definition of initial direct cost. Second, only incremental cost will qualify as initial direct cost. Third, initial direct costs are expense for operating lease. Fourth, leasee and leaser cannot have different initial direct cost for the same lease. What we have studied so far in this topic? This question can come in your exam also. This is like past year exams questions only, which is like I added all here in practical questions. Anji? Yes, what's up? Are you guys with me?
Yes, sir. ऑप्शन से देख रहे हैं एक बार सारे में.
Yes, yes. Okay, let's do one by one. First option, lessee and lessors will apply different definition for initial direct cost. Do they calculate differently? Answer is no, right? So initial direct cost is same for both of them. Yes or no?
Yes, yes, sir.
Yes.
Right? Second option, only incremental cost was qualified for the initial direct cost. The answer is yes. Only the cost which is directly paid for the lease agreement, which is incremental, not your regular expense, right? Third option is initial direct costs are expense for operating lease. The answer is no. It is clearly
No.
mentioned. It is deferred, right? Yes, no.
Yes, sir.
Yes,
Guys,
sir.
are you with me?
Yes, yes.
Yes, yes.
Okay, last option. Lessee and lessor cannot have different initial direct cost for the same lease. The answer is no, right? So that is the reason the second option is right.